Hello and good morning, and welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Hiren Amin, and I'm joined by my co-host, a couple of doors down, Jason Hnatyk. Jason, how are you doing?
I'm doing wonderful this morning here, and I'm really excited for the next hour to talk options with you, my friend.
Excellent. For audience members who are joining us today and interested in getting started with options trading, you're not alone. See, the popularity of options trading in Canada has surged in recent years amongst both retail and institutional investors. A recent study by data analytics firm Option Metrics tells this story. It found that the total trading volume of calls and put options on Canadian exchanges reached about 12 million contracts in 2022. That's up from just 1 million contracts back in 2010. So we've seen a staggering rise in options trading. Now, part of that appeal of options trading is that it can serve many different purposes, such as generating additional income for our investments to hedging our existing positions. But it's no secret that there is a lot to learn about how they work. And the learning curve can be steep for some investors. So, we're going to spend the next hour tackling your questions about options trading to help you get started. Before we get into our meat of our questions, I wanted to get our conversation rolling and talk a little bit about options in a generality and get a little bit of insight from you, Jay. So I know there's many different ways to trade options. I know both of us kind of had a little. Both of us put together, we've had quite a bit of experience under our belts. So, how did you get started with options trading?
Now, just to kind of preface that, what's always kind of attracted me to options, and the more I've kind of got more experience, it's really even kind of strengthened my kind of love of trading options. Is that there's so many ways that you can use an option, and you mentioned it in your opening remarks here, and how we can use options, and they can be cash efficient ways to speculate on a stock in any direction in the market. They can be great ways to hedge your portfolio, and they can also be useful in creating income in your account. And that income is kind of how I got my first start in trading options, kind of way back in the early 2010s. So maybe I was one of those 1 million contracts traded. Maybe that was part. Maybe I was claim to fame there. But trading covered calls on stocks that I own. That was looking to kind of supplement the dividend, looking to on things that I wanted to continue to own that I was feeling pretty good about. Maybe I was looking to take some conservative strategies. That's kind of over the years evolved into more complex strategies, but I still, I still have a soft spot for those kind of basics trades. There's no need to make things more complicated than it needs to be, especially from an options perspective. So that was kind of how I started, was just kind of just trying to leverage the positions that I had to see if I could generate a little bit more income coming your way. So I know you and I have got very similar backstories, in our history with options and working in the industry. So curious to hear how you dipped your toe into the waters as well, Hiren.
Yeah, I have a very similar story to yours as well, Jay. When I first began in the investing world, uh, I was completely green to investing. I'll say this, and I often say this. I was so green that I didn't even know what GICs were. So that tells you a little bit about the story of kind of where you can go in terms of options trading. But it was really learning, getting on the job, having to take our certifications and learning the theoretical aspect of it. But most of the learning really does come from experience. And so having like a play environment or sandbox environment to practice some of these things that you learn about, I would say is kind of your biggest asset to have when you're going through it. So that's how I started, and then I evolved into looking at different strategies, which we're probably going to talk about today. So we'll chat more on that later. So great to hear that, and hopefully this resonates with a lot of audience members as well. Because if you're starting out new, we wanted to mention, a question that we get often, and I'll pose this to Jay, is that we run master classes on options trading. We have a lot of investors who are looking to get into options. So Jay, is there certain common sort of questions or concerns that you hear from our usual audience members there in those classes?
Yeah, there, especially from new traders and new to options specifically, there are some, I don't want to say misconceptions, but just that people just don't know yet. You don't know what you don't know until you haven't had a chance to experience it. And we're going to
Yeah.
unpack some of those myths and maybe shine some light on some of those dark areas. But around options being all option trades being extremely risky. Yes, there are risks to options, just like there are to other investments. There's unique risks to options, and in some option trades are more risky than others. So there's not always going to be suitable for everybody. But people go in. Oftentimes, traders come into options thinking, well, they come in very with a trepidatious feel to it because they're unclear of how they're going to work or how they're going to be transacted in their account. So it's that risk element, but once again, it's also that opportunity to uh, use options in a way that are going to supplement and complement your other positions that are in your account. People oftentimes will come in thinking, well, I don't have unlimited amounts of time to do option trading. I'm already doing enough from a stock perspective. One of the nice things that I like to speak about is that a lot of the research that you're doing on your portfolio as a whole now, you're understanding kind of how you're feeling from a market sentiment perspective. You've got some ideas about where you think your portfolio or specific positions are going to go. Well, then as you become more experienced with options, you can then layer that in and use that exact research that you're doing to find trades from an option perspective that are going to support the work you've already done, the portfolio that's already in place. How about you, Hiren? Anything that you've heard from your experience on in the investment center as well as in our master classes that we present?
Yeah, I know the only thing I'll really add to that, Jay, is just the one thing is there's a misconception around that you need to have a lot of money to trade options. And as you already mentioned, there's such a variety of different strategies where it doesn't require a high amount of capital. And we wanted to unpack that, and we're going to unpack that. And so let's actually get to that. So I want, before we dive into our questions here for today, let's lay a little bit of groundwork for about options trading for those who may not be quite familiar. So I'm going to start off by asking, what is an options contract, and how does it work at a high level?
Yeah, let's check a few boxes. There are some key understandings that we need to be familiar with before we're going to go to kind of dive in and make trades in our own accounts. So we need to first say the options are going to be contracts, right? The contracts will have two sides to every contract. You have the opportunity to buy an option, as well you have an opportunity to sell options. And different, buying and selling activities are going to have different risk appetites, which will be learned about either in this class as well as future opportunities. But effectively, you've got the buyer who's paying the premium to buy that option. The buyer is getting the right to do something, right? They're in control of this option contract. The seller of that option is going to then, they'll be receiving that premium, but they're going to be then obligated to fulfill that contract if it, if it comes to that point during the life cycle of an option. Now, when we're talking about that buyer of an option, I think we'll focus on that because it is typically your more basic entry level position. The buyer of an option gets the right to do something. There's two types of options. We have calls and puts. The buyer of a call option has the right to buy the stock at a particular price, and the buyer of a put option has the right to sell the stock at a particular price. Now, that particular price is a key term to understand, is called the strike price. So, and when we get into viewing the strike prices in the option chain, we'll be able to visualize that a little bit better so we can connect the dots on this theory here. But you have the right to buy the stock with your call at the strike and right to sell the stock when you buy a put. The other big thing that we want to make sure we get out in front of here is that options are going to always be time bound as well. So options will always expire at some point into the future. There's going to be many different expiration dates for you to choose from when you're looking to purchase or sell your options. Something that might be as little as a few days away. Let's say coming tomorrow, there might be an options expiration date. Maybe something 3 weeks from now, a few months from now, or even out as long as a few years. But understanding that options will expire, so time is finite within an option contract, and time does have value. So we'll unpack that. I already do see questions coming in around theoretical values and things like that around option pricing. So we'll unpack kind of the way to understand the value of time. But just that is a concept we need to know, that your right to buy the stock or sell the stock at your strike price is always going to be yours up until that option expires that you own. Did I leave anything out there, Hiren? Is there any other kind of key concepts to unpack there?
No, you covered it. The only other last thing I will mention is the fact that as you mentioned, they are contracts. So they're actually under the class of derivatives options. So they, in and of themselves, they don't have value. They derive their value from the underlying asset that they're on. So we're talking about, you're going to find options usually on stocks, ETFs, and indexes. All right. So this is just one thing to understand. So they are inherently getting their value from the movement on the underlying there. But that's the only thing I think you captured. The rest of it there, Jay. Now the next question that kind of is logically to ask is, look, if you can do this, you can also do this with stocks. If you're buying a call, it's like buying a stock. If you're buying a put, it's like shorting a stock. So what are some reasons to trade options then?
And these are absolutely questions that we love to tackle in our master classes. And one thing I do want to point out is that options aren't for everyone, right? We're all here, and we're all at different points in our kind of learning journey from an options perspective. They come along with their own unique risks. So just before you're placing your own trades, you want to make sure that you've taken the time either to attend sessions like this, to watch the videos that Hiren has pointed out to. But each individual trade will have its own kind of risk reward profile that we want to make sure that you're comfortable with. But the main thing I want to point out for why options is once again, one of the things that attracted me to options was their flexibility. You have the opportunity to use them to really to tackle any situation. Okay, so if you've identified a stock and you think it's going to go up, and it's going to go up by this much over this period of time, well, guess what? We can find the right option strategy to put into that trade. So options can be used to speculate on the direction of a stock, ETF, or index. Options can be used to generate income. We were already talking about covered calls. There's other ways to generate income that might come along with a little bit of risk, but that's a key aspect of an option contract. And another thing that's really interesting about options is you have the opportunity to almost buy stock insurance on your portfolio, such as in using a hedge, right? So we can protect the downside on your investment, or you can protect the upside if you've got a short position in your account through the options. So it's that speculation, income, as well as risk mitigating factors that we can find the right strategy to work for you. And the other point I'll put out here is that, and you mentioned that options are derivatives here, and is that if we're looking to speculate along with the value of the stock, if I wanted to go buy 100 shares of a particular company, that may cost me many thousands of dollars. Well, guess what? Options, through the use of the leverage that they create, I can speculate along with that just by buying the option itself. So it can be a very much more cost-effective way to kind of experience those moves in the market that I'm expecting to happen. So that's kind of those are, in a nutshell, those would be kind of why options, and there's lots to unpack, but that would be a general overview.
Yeah, and I love that fact. The two things that really highlight or stand out to me is what you mentioned about capital efficiency. You're able to control a large position with a smaller amount of capital compared to, buying the stock or the ETF, etc. But the other thing that's also key is the flexibility. You can trade in any market conditions, whether that be bullish market conditions, bearish, or kind of just sideways movement. There's strategies available for all of it, which is kind of one of the draws of trading options there. Now, I wanted to just pivot a little bit, Jay, because we talked. I know in your when we asked you the first question, you mentioned that you can do both buying and selling of options. So let me ask you this: why might an investor want to buy an option versus sell an option?
Yeah, good question. And this comes down to a number of factors, and a lot of this also might be coming down to your own, well, two factors: your own level of experience with option, but also your risk appetite and what you're looking to take on from that perspective. When you buy an option, so if, let's say I buy a call option, it's a bullish position. I expect the stock to go up. I'm only going to be making money when that stock goes up. So I'm directionally focused on that trade in a bullish market sentiment. But there's a few things that come along with that, right? So I'm only, as we said, is capital efficient. I'm only investing a smaller amount of money up front. But the nice thing about that, because I've only invested a smaller amount of money up front, understanding what that option contract is, I have a right to buy the stock at a specific price. I don't actually own the stock outright at that particular time. So if things don't go my way, if I buy a call option, what that tells me is my max loss up front, I know, is already defined at the premium that I paid to buy my call. Same would be true if I was buying a put contracted as well. I know that I'm not going to be losing more money than I'm investing up front, but I do need that stock to go in the direction that I'm expecting it to go in for me to make any money. Let's turn that on its head and talk about selling options. Selling options,
Yep.
Yes, there's different types of strategies, and we can unpack them depending on the interest of the audience here. But selling options can come along with additional risk. But with additional risk, you can maintain some additional flexibility on how you're going to make your money. Now, when we know that the seller of an option is going to be receiving the premium from the buyer of that option, that's your capital that gets deposited into your account as soon as you do that trade. That money that gets deposited into your account, that premium, that happens to be your max gain, the most money that you're going to be making on that particular trade. We're going to then let's flip that around and talk about how the risk on that particular trade. So we know that with a long option, if we're talking about a call, the stock needs to go up, and it needs to go in that direction for you to make any money. Well, the benefit for selling options short, that it gives us the flexibility to make money in multiple directions. So if our goal as a short seller is to have our options expire out of the money, meaning if we're thinking about calls, we want that stock price to be below our strike price. And if it expires out of the money, we then are keeping all of our premium, and then that's our maximum gain. But the point that I wanted to clarify here is just as the stock can move in any direction. It can move down, which would be positive for us if we're talking about short calls. It can move sideways. It can even move up, but it just can't move up by too much. So we have that flexibility of allowing the market to still move, just as long as it doesn't move up by too much if we've sold calls, or down by too much if we've sold puts. Now, Hiren, is there anything you want to add to that?
No, I really just wanted to highlight what I've gathered from there is really the risk profile is different when you're buying versus selling. So it really is based on how much you're willing to risk, and really defining that risk level as well for yourself. So buying, usually, that the most, if the trade completely goes and you just leave it in the account, you're going to lose what you paid for it. It's not the case with selling, though, because it's something that you may want to actively manage a bit more, because if the trade does go against your view, then those losses can start amassing there on that. So that's just one thing that I wanted to just bring to light from what you were mentioning, Jay. The other thing I wanted to just go to was, there's a lot of moving pieces or variables to options trading. So what are some key pieces of an options contract investor must choose when placing a trade? So what are we looking to consider here?
Sure, and this is way I like to think about this to kind of simplify this, to start giving the beginnings of a trading strategy. Is I've got 4 simple questions to ask myself, and this is partly in line with kind of the comment that I was making earlier around not having to do necessarily additional research outside of the stock research you're already doing. We're just really looking to kind of narrow some of those facts down. And kind of the questions that I like to ask myself first would be, what direction do I think the underlying security is going to move? Okay, do I think it's going to go up, down, or sideways? So that would be directionally where's my sentiment on this particular stock. The next would be, if I've already picked the direction, well, what would be the actual price level that I think this underlying security is going to achieve? Okay, so it's moving this way, and it's going to go up by how much magnitude, or down by how much magnitude. So direction and price level. Third is, how long do I expect that to take to get to these price levels? Is this by the end of next week? Is it 3 months from now? Is it even longer? So that's going to, once again, if we remember the basics of the option contract, this should already help us understand, strike price, as well as timeframes. Okay, so we've already started to accumulate that bit of information. And the last piece around that would be, how realistic is this approach? Am I being very aggressive, or is this something that is it unrealistic that this should happen? There's other ways. There's ways that you'll be able to judge, how realistic that your ideas are. Whether or not we're talking about going in and looking at earnings projections, we're looking at analyst reports, we're looking at all of the other supporting information, whether or not from a technical or fundamental information. those can go all in to kind of help us get to these data points. But it's just really those 4 simple questions that I like to ask myself to begin picking out price levels, time horizons on, and then we can then begin choosing our strategy based on the direction of which way we think the stock is actually going to go.
Yeah, and one thing I would just add on to that as well, as you go through your options journey and become a little bit more savvy with trading options, there are going to be other elements that you may want to consider, such as, Jay mentioned that options are time bound, and so they have value. The closer they get to expiry, they naturally lose that time value. So that's a consideration as well. That's part of strategies. How much are we looking to take advantage of that loss in value? And that really depends on whether you're on the buy or the sell side of that, and how much it's going to impact you. The other thing that traders would want to consider is volatility, and we should talk specifically about implied volatility, and that's the expected future sort of range or swing that a stock can potentially have. And so, generally, doing higher volatile conditions, certain strategies are better suited for those. And lower volatile conditions, certain strategies might be better suited for those type of market conditions. And then the one thing that we don't want to forget from all of this is our Greek family, the option Greeks, delta, gamma, theta, vega. We will certainly cover these in a lot more depth and detail if that is something that you want to learn about in our master classes. So you can certainly check that out, and we're going to tell you where you can register for those. But those are also considerations that really impact the price of an option, and these are just certain different variables there. Now, I think we've chatted a lot about some of these concepts, Jay, so far, and hopefully you've laid a little bit of a groundwork here for everyone to kind of understand how they work. But it's going to be best if we can show them now. How do you actually see an option, and can you take us through a trade of an option? Like, let's just do buying a call option as an example there, and we'll show everyone how to place this trade there. So, Jay, I'll let you take it away there.
Yeah, absolutely. So let's do that right now. So we've unpacked some theory. Now let's put those theory to the application test in the platform. So I'm going to start sharing in web broker on my screen here. Let me just bring that up for the audience. I've just got the S&P 500 ETF by the spiders up on the screens. So just as a security to use. I'm looking at just the general summary of the ETF quote here. I've got, you can be found this under research, then under investments. If we choose stocks, we can just plug in whatever symbol suits your own situation best. But to actually find the option chain themselves here in WebBroker, you notice there's a number of tabs below the last traded price. Options happens to be the second tab down from here. Okay, so I'm going to go ahead and choose that. We'll load up the option chain just to kind of orientate everybody here. If we're down below the quote, you've got opportunities to sort and filter by strike prices and expirations and things like that. Additionally, all of the different expiration dates if you look, as we were saying, all options are time bound. They're going to have a finite amount of time for that they're going to be existing for you. You've got the opportunity to choose those right here. You're looking for something that's a little bit more long-term in nature. You'll notice the drop-down menu on the right-hand side of things. Let's go ahead and maybe go out a couple weeks out to end of next week, and then let's pull up the options from there. Maybe let's just quickly go ahead and buy, and maybe we'll buy a call option that's right around the current value of the SPY. So looking at the option chain itself, we'll notice we have calls on the left, our put options are on the right, and our strike prices are going to be running right down the middle. The option chain is conveniently color coded as well to help you kind of decipher what options are in the money, out of the money, or maybe even near the money. Okay, so we scroll down. I know the SPY symbol has a lot of strike prices, so we got to scroll down quite a bit. But if we notice here, we've got to a point where we have a horizontal green line running across the option chain. That's giving us an approximate quote of where SPY is itself. So we've got an opportunity to kind of judge which strike prices are in the money or out of the money. And once again, the color coding is going to help us with that. A key phrase that helped me learn about options, so I always can understand the in the money, out of the money relationship, it's a term called call up and put down, right? Options are in the money for calls when the strike price, when the stock has gone above the strike price that you own, and puts, it's put down. So puts are in the money when the stock goes below the strike price that you own. So let's just focus on these 450 calls. These are kind of the at the money option. If I wanted to buy these calls, once again, calls are on the left. All I'm going to do is click on the SPY symbol on the far left of the screen. And now it brings us into a pop-up window, which shows us a profit loss graph. It gives us an idea of how we make our money in this option. It's a long call, so it's a bullish trade. We're making money as the stock price goes up, and that's visible in that graph for us. If we want to proceed to the ticket, all we're going to do from here, go ahead and click on the buy button from there. The reason I like to do it from the option chain, for myself is it's speed. I already get my expiration date and strike prices already pre-filled into the order ticket outside of doing it manually, so it's a nice benefit there. We're going to be starting with the buy to open. We're opening up a new new position in the account. We've got our action button showing buy to open. There's other different actions which we can unpack as questions pertain to them. But buying to open is we're opening up a new long position we're holding in our account. In terms of quantity, this is the number of contracts that you want to buy. So that's not the number of shares you want the right to buy. This is the number of contracts. We're buying to open one contract of the particular expiration that we have on the screen. Really, the order entry process is the easy part. It's trying to identify the strike and the direction that you think the stock is going to be going to. But thankfully, actually getting the order to market is really not going to be much different from any other order you would be familiar with on the platform. Even the price types such as market and limit and stop limit are going to work identically to the trades in those other instruments as well. And then it's just a matter of getting your limit price in, but what you're willing to pay, and sending the order through. So hopefully that was a good description. Was there anything kind of left off here that you wanted to highlight for the audience?
No, you didn't leave anything off, Jay, but I did want to ask you something maybe for the audience as well. But you picked the SPY. So does that mean in the universe of stocks and ETFs, is there going to be options available on all of those instruments?
Yeah, great question. So know that options trade both here in the Canadian market as well as down in the U.S. market. SPY is a very broadly held and traded U.S. ETF. So knowing that you do have the flexibility of trading options in either of your account. So if you wanted to keep that flexibility and limit the amount of foreign exchange that you're taking place in, so going ahead and making sure you're efficient with the account. But to the question about options, once again, we know that the popularity of options continues to grow. The adoption both in the Canadian and U.S. market has been quite substantial over the last decade or so. But we can't say that all stocks have options. If they do not have options, this option chain will be blank. So I think most actively traded stocks, most stocks that are on like the TSX, your Dow, your NYSE, your Nasdaq, the bigger stocks will typically have options, but it will not be the case for all stocks. So you'll need to kind of look at that in a one-off basis to ensure that those are going to be available for your trading.
Yeah. So just as a rule of thumb, any stocks that's listed on a major exchange, whether that be on a Canadian side, the TSX Composite Index, for example, or on the US side, they should by and large have options contracts available through them, right? And the penny stocks probably will not have options trading on them. So just a quick FYI for everyone there. All right. Okay, Jay, so what we're going to do from here, we're going to come back in, and I think it's time that we get to the viewer questions now that we got some of the basics away. So we're going to start rolling those questions in now. So please, if you haven't had a chance to submit questions, please do so. Maybe some more questions have been sparked through our 30-minute conversation so far that we've had. So please do send them in the Q&A box, and we're going to get to them. Before we get to the first question, though, I did want to just mention that we are going to be throwing up a little bit of a trivia question up, and you'll be seeing that coming up on screen. So I'm going to read out the question, and you're going to be able to vote on what you think the answer is there. So according to a study commissioned by the Options Clearing Corporation, in short form known as the OCC, in 2020, how much does the risk tolerance of investors who trade options differ from those that do not? And here are the ones that you have to choose from. Option traders are much more comfortable with the risk. Or B, option traders are much less comfortable with the risk. Or is it C, there isn't really any meaningful difference between the two of them? All right, so I'm curious to see what everyone thinks on this question. Jay, I think we'll share our thoughts once we get some of the answers. But before that, while we get the votes coming in, we're going to go to our questions here. And I'm going to pose the first question that we have here. This is a question coming from Joe. So let's queue up the question from Joe. And he says, what kind of accounts can you trade options within? It's a good question. It's always nice to get those table stakes set. Jay, I know you mentioned that a little bit. So why don't you tell us what are the accounts available to trade options through?
Right, and this is another win for the flexibility of options. So you've got your margin account, which is certainly available to trade options in. But here's the nice part: you also do have the opportunity to trade options in registered plan accounts as well. So you've got your margin,
Okay.
then we've got your TFSAs, your RSPs, your RIF accounts, etc. You've got the opportunity to take and leverage the strengths of options in those accounts to help achieve your financial goals as well. Now, when we're talking about the trading between the different types of accounts, it's going to be a little bit different. There's 4 levels of option trading approval. Depending, and they go up depending on the level of risk that you're taking on in that particular trade. Margin accounts, you'll have the opportunity to trade all sorts of option trades, from your basic buy order to your covered calls, all the way up to your naked or uncovered options. Your registered plan accounts, so your TFSAs, once again, RSPs, etc., they have a limited option trading approval, but they do add those extra flexibility to the account. You have the ability in those accounts to buy calls and puts, and you have the opportunity to sell covered calls. It would be that's kind of the extent of what the government allows in those plans. So that's kind of where we're at, but it still does open up open up the door to many other trading possibilities if they suit your own individual personal risk appetite.
Okay, perfect. And just so everyone knows, these permissions, so they are permissions that need to be added on these specific types of account. They're not ready-made out of the box when you open these accounts. So at the time of the time, or I should say at the time when you open the account, you will have to select on the application that you want to have options trading enabled on there. If you've already had an account that's already established, then there's simply an options upgrade request you can make that'll add those permissions onto those respective accounts that you have. So great to know. So in summary, margin trading account on the non-registered is the one that allows you to pretty much do the blanket all strategies under the options banner. And then the registered accounts are going to be limited to the more risk averse type of strategies, covered calls, buying a call, buying a put is what you would be sort of limited to there. All right. So we are going to, we're going to still queue up. And I think there's another question that's coming up. Jay, you want to take this one?
Yeah, I'll absolutely take this one. But just also before we do that, another thing to add. Yes, we've talked about the educational resources you've got, whether or not it's from our YouTube videos and our playlist that we've got available to you on the console, or it's our master classes and our videos that you've got available in Webroker. Through the Learn Center, but additionally, we also have got great people that work on our option desk in our contact centers. So you're never out of reach if you wanted to talk to somebody about getting additional option approval, or even about the trade that you have in their account. Certainly, it's not an environment for us to provide advice to you, but there is an opportunity to discuss strategy, to discuss the profit loss scenarios and things like that. So just know that you do have a lot of support, especially for new traders, to kind of really make sure you're comfortable before you dive in. But okay, so let's take another question here. Hiren, let's pose this to you here. This one's coming to us from Sally. Sally wants to know, what does it mean to open or to close an option trade?
That's a great question. This is terms that are very unique to options. Unlike, with stocks or ETFs, you won't really find that there. So I'm actually it's probably best to demonstrate this to explain it. So I'm going to go
Great.
into screen share mode on Webroker and we'll show you. And I think you did show a little bit, but let's queue up Webroker here and we'll present it to everyone here. So I'm going to go back into screen share here. Now everyone should have my screen in view. I'm going to plug in a symbol here and we're going to just start, and I'm going to use DIA, which is, we call them the diamond, but this is an ETF that tracks the Dow Jones Industrial Average. Very similar to the SPY, but this one is tracking the Dow Jones Industrial Average. So if I go over to my options, and actually I'm going to show you another way you can open up the options chain. I can actually go right to the buy and sell ticket within here. And once I've selected the particular account that I maybe perhaps want to place this trade, I'm going to plug in the symbol. Now, before I do that, there is a separate tab for options here. This is kind of a bit of a manual process. Jake mentioned like you can do it right from the option chain where it pre-fills it. So you're going to kind of do a little bit of be filling yourself over here, but you do have an option chain within here. Now, once you select this, I'm going to show you, and we're going to pre-fill it in here. And let's say we see the market's dropped a bit, and maybe there's an opportunity to see a little bit of a bullish momentum come back over the next couple of weeks. So I'm going to open an option chain. We're going to choose an expiry that's 30 days out. And so you can choose your expiries right from within here. And we're just going to pick something that's pretty much near or at the money here. So how about we pick the 350, 250? And I'm going to click on the ask in order to buy this call. All right. So we got that pre-filled here. Now, this is where that question came in. What does it mean when it's open or to close? And if you come to the action drop-down menu here, you're going to see a number of different choices that are presented to you. So anytime someone wants to go long an option contract or wants to be a buyer of an option contract, their opening action type is going to be what we call buy to open. Now, you'll notice there's also something that says buy to close. Now, that's different. And we're going to talk about that based on what their opening maneuver is essentially. So if I'm looking to open or simply do a buy, just as you would like a stock, you just want to enter the position, this would be the equivalent of doing that, buy to open. Now, if I want to then turn around and sell this option contract, okay? So maybe I made a little bit of money on it and I've said, okay, you know what? I want to sell this contract and realize that potential profit that I have. In that event, I would come down to the action type and choose sell to close. So it's just the opposite. So we're doing exact opposite. If we did a buy to open to initiate it, we're going to do a sell to close to collapse that trade. Okay, so we're closing out the contract there. Now, you would also notice that there's a buy to close, as we already talked about, and there's a sell to open. Now, whenever you see the sell to open here, that means you want to short it. I'm not going to go into the specifics about covered or uncovered, but just remember, anytime you see sell to open, you are shorting that contract, all right? And you're entering a short position with that, and then simply, if you, let's say you do that and you want to repurchase back that short position, because if you're short the contract, you have to buy it back to close it out. Well, then you would choose buy to close in that eventuality. All right, so that's just to clarify what these terms mean. It really represents what is your opening position or closing position as reference. Okay, so if we want to buy, we're going to do a buy to open. If we then want to sell that position that we bought, we're going to do a sell to close there. Jay, anything I missed out on that you would that you want to cover?
Just one thing that it's maybe it's just me liking to be efficient, or liking, maybe I don't trust myself to enter the ticket accurately. But if you have a position in your account, it's going to show up in your holdings. So if I bought to
Yes.
open a call, it'll be in my holdings. If I quickly wanted to open up an order ticket to sell to close on that option, from my holdings page within WebBroker, I can click on sell, and it's going to immediately draw up the right contract, the right expiration, strike price, and the number of contracts that I own. So it's just a really quick and easy way to get the ticket populated and to ensure accuracy as well. So once again, everything is in the holdings, and it's just a convenient way to execute the trade from there.
Absolutely, yeah. The system is kind of I guess smart that way. It'll recognize whether you have a long net position or your short position, and so it's automatically going to pre-fill this for you when you're doing it through that holding screen, as you mentioned. So, great call there. All right, so we're gonna come back into the room and go through the questions. We're gonna get to our back to our trivia here again. So, uh, and I think everyone's had a chance to vote on those answers. So we're gonna queue up, and we got a majority of people have said option B, that option traders are much less comfortable with risk. All right, so should we queue up the
So we went the
actual
other
answer
way
then?
on it.
Yeah, they did. They did. Okay. So the actual answer is for those 25% of you who did vote for option C. There isn't any meaningful difference between the two. And a 2020 study that was commissioned by the OCC found that 29% of option traders said they were very comfortable taking high levels of risk in return for significant gains, compared to just 24% of non-traders. But interestingly, those who traded options perceived them as less risky and reported that higher levels of investing knowledge than those who hadn't traded options before. And I'll get your thoughts on it in a moment, but this doesn't surprise me, because when options were first brought into the marketplace back in the early and I might be off on my timestamp here, but early to mid 80s, they were really brought as a tool to manage risk. That was what it was brought in for, to manage risk and portfolios before it evolved to become, generating income and then for speculation purposes. So, this is something that doesn't surprise me when I do see it for those who do understand options there. Any thoughts on that, Jay?
And even just to kind of relate to the audience there about options traders being less comfortable with risk, and that would be, once again, options can be what you want them to be. So if
Yep.
you want to have a risk defined trade, you're not comfortable with unlimited amounts of upside risk. If the stock moves up, then guess what? Then there are trades and strategies to implement. But being there that it's balanced from stock and option risk from a study that was done by the OCC, that makes sense to me, just because the trades the plethora of trades that we have to make, some take on risk, some remove risk. So that seems to make a lot of sense to me.
All right. Excellent. All right. We're going to get back to our regular programming of questions. The next question we're going to queue up. This is coming from, I apologize for my mispronunciation, but Jay. Uh, and the question is, it's related to a strategy, the covered call. Can I still sell the shares I own during during, I guess what he's trying to say is when I hold a covered call. So this is a question we got a lot, Jay. What would you say to that?
Yeah, and I'll maybe I'll throw out a big depends on that question, right? That depends
Yep.
on the account that you're doing. It depends on the risk that you're willing to take on. There's factors at play that we want to understand before we make that decision. Because when we have a covered call, our shares are covering a short option that we've sold, and are covering the extra, potential upside risk that you may have. So if you've made the determined that now is the right time to sell on this particular stock because you don't think it's going to go up anymore, then you certainly could, if you're in your margin account and you had level 4 option approval, which allows you to have naked or short uncovered options in the account, so that you would be able to sell those shares. But keeping in mind, if you sell those shares, you now have a short, naked, or uncovered call in your account, and you're assuming all of the risk that comes along with that particular call that's in your account. So meaning that if your expectation of the stock is incorrect and the stock does go up, you're opening yourself up to potential losses that weren't there if you still held on to the shares. So that's a big if. So just because you can do it, it doesn't necessarily mean that maybe you're going to be comfortable doing it because of what can come along with that. So that would be a possibility in your margin account if you've got level 4 option approval. If we're going to talk about the registered plans, because covered calls are a fairly common strategy in a registered plan account, it's a much quicker answer there. The answer is no, you can't do it, right? You're not allowed to have naked options in a registered plan. You're going to be required to, if you do want to exit the shares, you're either going to need to close down the covered call by doing what we call as an unwind, by selling the stock and buying the calls back at the same time, or you're going to need to buy back those calls first, so you can then sell your shares if you're going to do it separately as 2 transactions. So the answer is yes, but with the big depends on there as well. Anything to add to that, here?
No, you covered it, Jerry. I think it's just very account specific and option level specific is what we want to just bring out to everyone. And don't forget, you open yourself up to a whole big can of risk. Certainly when you've got that collateral, essentially, it's like collateral against that position when you take that collateral away there. So that's just something I would add there. And yeah, other than
We
that, you've covered it there.
Now, we do teach classes. If you are interested in selling options and you do want to sell them as uncovered, keep in mind the risk is one of the things we always like to mention. But we do teach specific master
Mhm.
classes on selling options for income. So just know that you've got the next step in your learning journey is available. Take a look at our options masterclass schedule, and we'll be happy to join you for another long, hopefully engaging hour-long conversation on those specific strategies as well. Okay. All right. Well, let's get to our next question here. This one comes to us from Terry. Terry wants to know, how is the theoretical value of options calculated, here?
Ooh, that's a big loaded question.
A lot
So
to
I'm not
unpack on that
gonna
one. Yeah.
lot to unpack. I'm not going to go through a big spiel about math or anything, but just to paint a picture, this is a question that comes up all the time is when you see an option, we see the prices and everyone's asking, how do they come up with that price? How do they figure out that this certain strike should be valued at this much? Well, the basic answer I'll start with is that there are models, theoretical models that calculate that value or premium. The most common one that you might come across is what's known as the Black and Scholes model. And now, so this mathematical model takes into account a number of these different variables that impact an option, things like volatility, things like the price of the stock, the time value, etc. And those all get factored in to then spit out this theoretical value. Now, I did want to go back into WebBroker because there is a tool that allows you to see the theoretical value, but also to change some of the variables to then be able to what we would call forward testing. You can test different scenarios if you're considering a situation. So let me jump into back into WebBroker over here, and we're gonna take down our order entry tool here. So if I come back onto the main overview page and we actually load up the options chain back within the overview, and we're still I guess in this case I've got the DIA diamond still queued up. Now, note that we were first discussing that we were looking at that 30-day out options expiry, so it's September the 1st there approximately, and we were looking at that 352.5 strike price. And I'm just wondering if I can just simplify this for everyone and say, let's just look at the in or slightly out of the near the money options. And I'm going to just, so this way we can narrow down our chain. Okay, so this is the one we were initially looking at, the 352.50 strike. Now you can see the price is showing as $5.05 on the bid, 5.15 on the ask. All right, the last traded price was $6.53. Now you can actually do a little bit of testing, as we mentioned. Now the way you can access that forward testing or theoretical tool is you're going to notice there's an analytics tab over here, and there's a little plus icon in it. And if you actually click on this to expand it, what it's going to do is it's going to change the sort of look of the chain now. So now what you have is you have your calls at the top and you have your puts at the bottom, and there's some more information that's going to be presented to you. The delta, gamma, theta, vega, which we call the option Greeks, are going to be displayed over here. But interestingly, there's also a column that shows us theoretical value there. All right, and you can see the theoretical value showing $7.01, and well, it's completely off from where the bid and ask is currently sitting at. So you might be wondering, well, how's that figured out right now? So there is a system in place where there's a mathematical model, but what we can do with forward testing is we can change some of these variables that impact the theoretical value over here. So for example, let's say this is still 30 days out for expiration. Let's move the expiration up, and let's say we've already gone through two additional weeks. We're fast forwarding 2 additional weeks. So now there's about, let's say, 15 days left till expiration. We're going to assume that the stock price remains exactly where it is, everything stays in place. And if you hit calculate, what this is going to do is then tell us, well, through the passage of time, how's that going to change the value of my option? And we can see over here in this case that the value of the option has dropped significantly from where it was. Now, additionally, I could say, well, what if the stock is going to go up? Then what would be the value of my option? And that's a big variable. So let's say if I think it's reasonable for the stock to at least get up to maybe, let's say 355. All right, so 3 more points up from where it is currently, and I hit calculate. We're still 2 weeks ahead of time, and if we hit calculate in this case, we want to see now, well, what's the value in that eventuality? Well, it would be $6.07 there, right? So these are some of the tools, this is the theoretical value essentially. As I said, it's calculated off of this model, the Black and Scholes model, and it takes into account some of these variables to come up with that price. But essentially, what we've done is on the back end, that model's already placed in there. You can just make these adjustments to then test your strategy. And if you're thinking of buying this covered call, what is that going to mean when different things are going to happen, when time moves forward, when stock price moves either up or down, and also volatility? Don't forget that if we're seeing volatility increase or decrease, that can also impact that as well there. Jay, anything to cover off?
I just want to say I really love this tool. It helps
Yeah.
me understand, like, you can put in different scenarios for the market. I can prepare myself for something going my way, or I can prepare myself. Well, what happens if things really get off the rails here? What's going to happen to my position if the stock goes up, if the stock goes down, if as time passes? Maybe there's a big spike or compression of volatility. How is that going to impact my position? You know, for me, it's just one of those things. I'm a bit of an analytical guy, so I like to kind of think through all of the different scenarios, and it just also helps to remove a bit of the emotion from the situation, because I've been able to kind of game plan and see what theoretically will happen based on expected events. And if they do happen, then I'm like, okay, I'm ready for this. I've seen the numbers, and you can already be, once again, well prepared, armed with information to execute on your own plan.
Yeah, and I like that point you mentioned about taking the emotional out of trading, because when it gets to options, you're really going to go through cycles of fear and maybe greed. And having this tool is really helpful to stay disciplined. Okay, and that's one thing that I really want to emphasize is when you're trading options, set up a plan in place on when you're going to get into the trade and when you're going to exit. And you can do that based on using this tool to figure out what's your maybe your profit taking level, and what might be your level at which you might want to take off losses off the table there. So great point there. So we'll come back in screen over here and rejoin back with the questions here. So let me switch back and we'll queue up the next question that we have here from our audience members. So this question is going to be a question from Bruce. It says, in your opinion, is it generally a good idea to let an option expire or close out the position before then? All right. So, Jay, what would you say to that?
And I think Bruce was thinking right along with you as we were discussing the theoretical tool there. This can be very helpful to understand if this is a worthwhile thought process as well. But so again, this is maybe giving me going back to how we answered the last question around closing out the cover call. This is also kind of one of those multiple choice answers, that it's really going to depend on what you want to happen or what your exposure is for your particular position. So if we're long an option, right? It's okay, what is my right? What's going to happen if I let something expire? Is my option in the money or is it out of the money? Okay, so with calls, once again, remember I talked about being call up. If the stock is in the money, the strike rather is in the money. If you have a call, the stock price will be above our strike price. Well, if I own a call, I have the right to buy it at the strike price. Well, do I actually want to own those shares? Do I have the money in my account to own those shares? Do I want the risk profile of owning those shares to be in my account? So it's, what do I want to happen after the trade is going to expire? So with a long option, do I want to buy the stock or sell the stock at my strike price? If I do not, then at that point it's like, okay, well then if I don't want the expiration through the exercise process to affect me, then my next then course of action is going to be to close out those options, right? So it's all really about what I want to happen. We talked a little bit around options being sometimes efficient use of capital, right? I don't need to invest. We were looking at, this SPY and the diamonds. I could be buying options that are much less expensive than buying the shares as well. If I don't ever want to, put out that money and buy it at the strike price, well, guess what? I have the opportunity to sell to close on my options, and I've speculated and hopefully made money if I can buy low and sell high on my option premium without ever touching the underlying stock position as well. Now, so we've talked about closing it to maybe lock in some profits, but there also could be, the opportunity to close an option to help manage risk as expiration approaches as well. From a long perspective, right? If I don't want those shares to be exercised, I don't want to take money out of my account to buy a stock or borrow money to sell short. I'm going to be like, if it's close to being in the money, I can then sell them to exit my position, so that I know that I'm not going to be at risk of that exercise. But also from a short perspective as well, we know that we make our max gain from a short option if our options expire worthless and out of the money. if that's a certainty to happen, then we can allow that expiration to take place on its own and not have to spend extra capital to buy back our options or spend extra commissions to close them. But if your options are either in the money or if they're very close to being in the money, that might be an opportunity for you to, with a small expenditure of capital, to buy back those options to really remove that risk of that assignment that may come. So I guess as a brief synopsis to that long-winded answer, the opportunity to close is something that we'll need to consider based on what is my what is going to happen to my trade if it expires in the money? Do I actually want that outcome to happen? And do I have the money, and am I willing to take the risk on of what that next step looks like? So that would be kind of my thought process as I go through that. There is a lot of different kind of boxes to check, but it's really about thinking critically about, well, what happens next if these expire in the money?
No, that's a good way to think about it. I think if I can tell about my own experience trading options, being both on the long side and the short side, I've always had the view that, look, if the trade doesn't go my way on the long trade and you're pretty much out of the money, I still want to salvage some value if there is any value left, if I'm holding it to expiry. I generally don't like holding options that are long to expiry, just because you have time value then sort of chip away at whatever is going to be left. So I generally tend to want to close those out. And the way I'd make that big assessment, if it's really come down in value, is whether the commission is going to be more than what the value is left. And if there's more value left than what the commission is, then I'm going to most certainly close that out and scrape together whatever, 10, 15, $20, whatever that may, rather than having it run dead in the water and let it expire. On the opposite side, if I'm short an option, and let's say, I think it's natural, if the option's running away from you, then of course you're going to close it, unless you want to get assigned. But if it's working in your favor, and this, a lot of traders want to have that option expire the money, so they tend to want to hold it all the way till then. But a lot of things can go wrong. So if you have profits that you can take off the table a little bit sooner or near the expiry, then I think in practice I've done that. And I think a lot of traders that we've interviewed, they generally don't want to hold it all the way out there, just because there's risk that it could run away from you, just to scrape together a few more 10 or 15 cents just to hold it for a few more days. So I would say, just that was kind of my own experience as well, that I can narrate there. All right. So I
Maybe
think,
one thing.
yeah, go ahead, Jay.
Well, I was just going to say, just to kind of further your point that you were making here, is that, and as new option traders, maybe you're looking to have, you're maybe not trying to manage them as actively as possible, but options don't need to be set it and forget it types of trades. Yes, you've got you've got a time frame that you're working within,
Yep.
but you should always be asking yourself. Remember those 4 questions that we talked about in the opening of our time. If your sentiment on the stock changes, if you really don't believe the stock is still going to go in the direction, or maybe there's not enough time for the move to take place that I need to happen in the stock, those are opportunities. You're continuing to calibrate your expectation of what you think is going to happen with that particular investment, so that that might be your trigger point, that you're going to be exiting your position a little bit earlier, as opposed to waiting towards that option expiration date. And then you mentioned as well, Hiren, and we had a graphic up on the screen earlier, is that steady, slow drumbeat, that decay of time that that does start to ramp up exponentially as we approach expiration. So making sure that we're always kind of keeping that. Is time helping or hurting us, depending on our side of the market that we've chosen? So it's just, don't set it and forget it. Be engaged with your accounts, and it's going to help to make sure that you're going to be able to manage those winners and the losers, and not allow trades to run away from you, and to have losses that you're maybe not. They're going to kind of creep past beyond what you're willing to accept.
Absolutely, well put there, Jay. I know we can chat about this until the sun sets here, but unfortunately we are at time, so we're going to have to leave our conversation here for now. So thank you so much once again for tackling all these viewer questions along with me, Jay. Really appreciate that. And of course, to our audience members, a big thank you to you for submitting so many great questions. We hope you're able to come away with something that's going to help you become more confident in journeying into the world of options trading. Please remember that Jay mentioned you have a number of different supports available to you through the contact center if you needed some, talk through some mechanics of the trade or even concepts. But you also have myself and Jay, along with some of our instructors, Brian, who are teaching options on a regular basis. We go into some of the nitty gritty. So if you really want to dive into it, join us. So once again, a big thank you, Jay. I'll give you the final remarks, and we can call it a day here.
Yeah, here, and I want to echo, it's been a great pleasure to have this opportunity to kind of pull back the curtain a little bit on options. But just to reiterate, be hungry. Always be looking for more information. We've got lots of valuable resources, whether or not we're talking about videos or interactive master classes. Come engage with our instructors. Come engage in our material. We're here to support everybody's individual learning journey, and options can be a valuable part of your own individual investing strategy. And yeah, till next time, we're hope everybody enjoyed the session, and thanks so much for tuning in. Hope everyone has a wonderful day and happy trading.
Have a good day, everyone. See you all next time. Bye now.